Hey, what's up, everyone? How you guys doing? Welcome to episode 4 of the Real Estate Talk. I'm Abel Mansour.
This is Burhan Khan.
And today we got a special guest here with us. His name is Egeorge. 2 first names.
Yes.
How you doing, Eric?
I'm doing fantastic. Thank you.
Awesome. So I know you came down from the Fredericksburg area. So how was that drive over?
It was not too bad, surprisingly. As those who ever go south on 95 know, it can be kind of a crapshoot. But just Fredericksburg to right here in Springfield, just about an hour.
That is awesome, man. I know that DMV traffic can be a headache from time to time, right? Yeah. You're 1 minute, it says 30 minutes away, and then once you get on 95, it's like an hour and a half.
Yep.
Like, where did the time go? Yeah. Awesome. So, Eric, you're a commercial lender.
Yes.
Right? Okay.
Yeah.
So, can you tell us a little bit about what you do?
Yeah, absolutely. So I'm a commercial lender with Link Bank, based out of Pennsylvania. Link is a very fast-growing organization. We do all types of lending. So we're a full-service consumer lender. So anything from, you need a personal checking account to you're buying your first home or second home or multiple homes. We got that covered. On the commercial side, which is what I do, is any type of business transaction. So anything from as small as, hey, I'm buying an investment property in an LLC, all the way up to I'm an operating company looking for a $10 million line of credit for working capital purposes.
That is awesome.
Yeah.
How's the year been so far as lending wise?
It's starting to get good. It's starting to get good. With rates, as you guys know, rates have been technically historically high, but only if you use the last 10 years as historic.
Yeah.
And so with rates starting to level out and actually come down, you're starting to get rates below 7%, 6.5%. People are starting to get really comfortable with lending again and buying property, buying equipment. The main thing will be, we'll see what the Fed does with the cutting the rates. That will really affect more of the floating rates, things like the Wall Street Journal Prime, more of the floating rates. That's where that impact will happen more.
So one thing everyone's talking about right now, Eric, is how commercial real estate, you want to stay away from it. Everyone's scared to buy commercial real estate. What are your thoughts on that?
I don't. So if you're just a casual investor, was like, hey, you're trying to flip a property or something like that, I don't think, personal opinion, I don't think commercial was ever designed for that. But if you're actually buying a property that has good historics or has underperforming historics, but you can actually bring it up to market prices, then go for it. It's all a matter of research. You can have the same that Alexandria, for example. A block apart, you can have two properties. One has been managed very well for the last 10 years, has amazing historics, and they go to sell it, and they sell at a premium. Well, that gets captured in appraisals. And it's like, hey, this property just across the street sold for $3 million. And so what should I be able to sell my property for? $3 million. And so they then go to sell it, but you haven't managed the property well. It doesn't have the good historics on it, so it doesn't, Ron, you know this, it doesn't debt service at the level to support a $3 million loan, essentially. And so you then have to back it off, go, well, the historics, the value of the property may be X, but its actual underlying value of the operating company can't support this amount of debt. And so really, you just have to do your research at the end of the day.
Yeah. So let's for our listeners there, let's say the people that are interested in getting a commercial loan, what's the first step that they need to do, and essentially to come to you? They say, hey, Eric, I want to get a loan. What's the first thing you advise them to do?
Let's stick with real estate for an example. It's like, hey, I'm trying to buy a real estate property. One is like, have you actually done the research on this property? It's like, what's your plan with it? If it's if they're buying a house, going to put it in an LLC, it's going to have tenants. Awesome, perfect. Are you going to manage it yourself, or are you going to pay a company, to manage it for you? From there, I'd want, since there's not going to be any real historics on that, I want some sort of market analysis. I'll do a lot of that myself. But really, tax returns, couple years of tax returns, personal financial statement, and really the business plan at the end of the day is one of the main things. And it doesn't have to be a formal business plan. I just need to know you actually know what you're trying to do.
Trying to get into. Yeah. No,
whether you know how to accomplish it, but I always want you to have some sort of plan of what you're actually trying to do.
So a majority of the people that would come to you, do they come in with a property, let's say an apartment building already in mind, or do they say, you know what, I need a line of credit to be able to buy an apartment? I don't know which one yet, but I need to.
So I wish it were the latter, but a lot of times it's more the former, where they're just like, hey, I've already signed the sales contract. Can you provide funding? And I was like, well, now I know. Yeah, now I'm playing catch up instead of trying to put you in a position where you're going to actually be able to succeed. Because if I'm able to get for the most part, a loan request up front, I can actually find out like ahead of time what you're actually going to be able to afford.
Okay.
And at the end of the day.
So majority of it, people already have the building or the business that they have in mind before.
At least an idea in mind before they're even coming to talk to me. Like I said, I wish it were the other way around, where they're talking with me ahead of time.
Versus when you like buy property, or if you're buying your home, you need that pre-approval.
Yeah,
that's not necessarily the case for commercial loans.
On the commercial side, there's almost no such thing as pre-approval. Like
that's a great question. Why is that? Because I've done a few commercial deals. And every time you guys give something like an LOI, letter of intent, but you guys don't give something known as a pre-approval. Why is that?
It's because it's so if it's an operating company, going to buy an owner-occupied property, we're going to be looking at that company. Like, what can this company actually afford? What can it can do? What's its debt service? What's it currently paying in rent? Add that back. Hey, that's going to essentially be the mortgage. Cool, we're good. You can get a loan up to X amount. If you're buying an investment property, we don't have the details of how much you're going to be able to get in rent. We don't have the historics. A lot of times you don't get the historics until you put in an LOI. A letter, it's like the person who's selling the property, they're only going to give you so much information up front. They want to know if you are serious. And so sometimes it's no fault of the borrower that they don't have the information that would allow us to provide basically essentially what would be a pre-approval letter. It's just there's too many variables.
So for those that are wondering, an LOI is a letter of intent.
Yes.
So when someone's trying to buy a commercial property, they have to write a letter of intent and then essentially submit it to you? Yeah,
they're usually, a letter of intent is usually going from the potential borrower or broker or their broker to the seller.
The seller.
Correct.
And then the seller will then provide usually historics and some other details to the borrower, who then provides it to me, and I start underwriting to try to find out if what loan amount would make sense for this based upon how much this property revenue is actually going to bring in.
But even before that, we start with the LOI, the letter of intent. And before you start working on that, we have to make a contract. And the contract is structured first, and then you start working on the numbers.
Yeah.
So that's how it usually works on the commercial side. Residential side, whenever you get a property, you don't even put together an LOI. You go straight to the contract.
So let's say someone is interested in buying like a fourplex or something like that, and they want to do it within their LLC. But they intend on living in one of them, renting out the other three. Is that something that you guys would entertain? Would you consider that like as a commercial loan?
Oh yeah, that's 100% commercial loan. If anything is in an LLC, it can be argued to be commercial, even if the owner of that LLC is living in one of the properties. You just have to make sure it's structured correctly.
Well, actually,
and
Eric,
the payments are going.
If it's 4 units or less, it's still considered a residential loan. If it's 5 units or more, then it's a commercial loan because it's considered multifamily.
Multifamily. So from the lending side, like being able to, you're saying you fall under a residential
4
lender.
units or less is residential, but 5 units or more, then it becomes a commercial loan.
So I guess my question was, if they went under the LLC, would they still be able to get it as a commercial loan, even though it's 4 units?
That's a great question.
And
so from my understanding, from deals I've underwritten, deals I've closed, is you'd be able to get a commercial loan to buy that property because it's going to be an income producing property. One of the units is not going to produce any income. That's the owner. They're going to be a full guarantor and everything like that.
But why would you want it under a commercial loan? So commercial loans usually have a 25-year amortization schedule. Residential
versus a
loans
30.
Yeah. So it doesn't make sense to get a commercial loan for a fourplex.
For a fourplex, okay.
Yeah.
So, some of it has to. There's different schools of thought, obviously. One is it's an LLC, so it's a protected. So versus like if you're the landlord, if you own it, you're renting out, it's in your name personally, and you get sued.
You're liable for that.
Yeah, not only is the property being able to be sued, but you and your other assets, other properties you may have, full encompassing.
Cool.
Well, if it's in an LLC, it's only whatever the LLC owns
Have you ever come across situations where it makes sense, even though like you said, the loan amount might not make sense for the commercial.
Yeah.
But is there situations where you have seen where people have went that route because it makes more sense for them or for their business or any kind of other way, like a tax write-off or anything of that nature?
Well, yeah, there's a lot of factors that go into it. That's why having the conversation with the person, like, what are you actually trying to do, is the most important conversation to have with the person. I always say, commercial lending a lot of times is an art and a science. The science is just the numbers. It's just does it debt service? What's the loan to value? Do they have the collateral improperly in place? That's just the science. Very, very simple, not easy, but very simple to figure out, very simple to do. The art side is how you structure a deal and if the deal even makes sense. There's situations where the science will be 100% golden, 100% golden, but the art, you just go, nah.
Doesn't make sense.
And so he knows that. Off the top of my head, I don't have them memorized, but you know the 5 C's of credit.
Correct.
One is character. Character is 100% art. You're not going to find make inferences on character on the credit side, on the science side, but it really is sitting across the table and having that conversation and going, I've got a weird feeling about this guy. I got a weird feeling about what it is that they're actually trying to do in this situation. And so there's times where science makes sense, art doesn't, so we're not going to do the deal. And the other way around where art makes way more sense than the science does. And so let's try to figure out a deal to make this actually work because the art side is so strong. It's so strong that we want to do business with this type of business or this type of person that we're going to structure it appropriately. Again, we were talking about risk before we started recording here. We don't do unduly risky loans, right? Like we have regulators, we have all that sort of stuff. But there's ways for us to try to figure out how to structure it, whether it's different loan to value ratios to get us in the proper positions or different type of covenants that you can apply. So it's the most important part is that conversation is like, what are you trying to do? And maybe it does make sense to buy this building and put it in an LLC and you're good and it's going to generate income for you. Or it makes sense because you only care about that monthly amount. So you want that 30-year mortgage, the 30-year amortization. So you're going to put it there because you don't care about the liability side. And it's just a matter of conversation.
A matter of value.
In regards to the risk, I was working with the borrower this morning, right? And he's actually getting a great deal. He's getting a property that's worth, twice half the market value, right? It's worth almost $700. He's getting it under contract for $350.
Nice. Yeah.
But he told me the lender's still forcing him to put 20% down on a DSCR loan, debt service coverage ratio loan. And why is that? Why do lenders, even if they know the property's worth significantly higher, you still force borrowers to put 20% down? What's the reasoning behind that?
Was this? I want to ask that question. Was this with a traditional lender or with a non-traditional?
A traditional
lender. Okay. A lot of times is we want to see buy-in.
Buy-in, that's what I heard.
A lot of times it does go to that character side, where it's like, all right, yeah, cool, you're going to be in a great position. A lot of times, so it gets lost, it gets muddled a lot of times. We talk about loan to value almost all the time, but if you look at almost any term sheet, we put in their loan to cost as well. And the loan to cost is how much did it cost you?
The contract. You look
Exactly.
at that's what
Then
he
we're
was
looking at
pointing
the
out.
contract.
The contract, even
Yeah.
though he knows that the appraised value or market value is significantly higher, he
Yep.
was complaining about that.
Yeah. So it's like, he's going to be at let's just use a number. He's going to be at 50% loan to value,
And the market value.
but the bank is financing 100% of the cost.
Okay, exactly.
Correct.
And so he has no buy-in.
So for
Yeah.
those that are like listening to us and that are completely lost right now, can we break down what a traditional and a non-traditional lender would be, and what would be the benefits of using a traditional lender and a non-traditional lender?
Okay. So traditional lending, I can talk more about. Non-traditional lending, you can go 1,000 different directions. Like there's 1,000 different forms of non-traditional lending out there. From someone who's just like, hey, here's money, buy a property, pay me back 20%, or whatever, just a flat 20%. That's a non-traditional, we'd call private money or something like that. Mm-hmm. Conventional lending, where we're going to, for high majority of borrowers, the main thing that we're going to be doing is we're going to be taking a holistic approach. Mm-hmm. So we're going to look at the property, the property or the business, whatever type of loan we're doing. Does it make actual sense for it to buy a piece of equipment, or for it to have a line of credit, or for it to buy a building? And we're going to look at the guarantor, the owners of the company themselves, mm-hmm. and we're going to make them personally guarantee that if the business stops paying, they're going to pay. Yeah, mm-hmm. themselves personally. They'll take over the debt
They'll
payments.
be the guarantors of
that's
the
one
loan.
of the that's one of the main things about traditional lending. The benefit of that, because a lot of people don't like to personally guarantee, is like we run into this all the time. I want to do this risky transaction, but I don't want to risk any of my personal assets.
Yeah.
I want the bank to risk all.
Risk it all, bank.
I run into that all the time. I've had people ask, how do I get 100% financing? It's like, one, you wouldn't want it if we offered it.
Yeah, exactly.
We're very heavily regulated. Mm-hmm. So that actually is a benefit, believe it or not, is because we have to do things above board. We can't charge you ridiculous amounts of rates just because we don't like you or whatever. We have to structure all of our loans somewhat the same. Whether you're high-level borrower or a quote-unquote low-level borrower, we have to structure them the same because we get regulated, our loans get looked at, and so we can't stiff the little guy so that we can pass on the savings to the big guy. Yeah. Non-traditional lending, a lot of times what you get is you don't have to do personal guarantees. Like that's when you said a DSCR loan. Mm-hmm. There's lenders out there or lending companies out there that will provide DSCR loans.
Again, DSCR for our listeners.
Debt service coverage ratio. And basically what that means is how much debt can this property or company service. Mm-hmm. And there's usually different ratios. So take your net operating income, divide it by 1.2. I think that's right. Divided by 1.2. I always forget it's a multiplier divide.
And easier way.
And that's how much debt that company can support, essentially.
Okay. An easier way to say it is for every dollar your company makes, they're willing to lend you $1.25.
Pretty much. Yeah. That's a great way of putting it.
Yeah.
Great way of putting it. So with like that type of lending, they're gonna just look at what is the DSCR. Mm-hmm. What is it? All right, cool. They'll lend to that. Benefit is usually no personal recourse. Major drawback usually is a lot more expensive. The private money, they don't have to keep deposit ratios. Like they don't have money on deposit. And so all of their money is coming from private capital or from private other people. And so they want to make their money back. And so they usually just charge a lot more. They usually would deal with higher risk loans. So if you're a high risk person, like if a traditional bank won't touch you, or if you don't want to deal with a traditional bank, they're great alternatives. They're just going to charge you a lot more.
So high risk, you would say, is somebody with not such a great credit, or what's classified as a high risk investor or a high risk lender, a borrower?
Yeah, certain industries are just higher risk by nature, and it fluctuates it can fluctuate year to year. Traditionally, like event centers are higher risk. Events come and go. New ones get built, and people don't want to go to the old ones anymore. Hospitality can be high risk depending on the market. There are some markets where it's like, yeah, heck yeah, I'll do a hotel deal. Other markets you're like, you couldn't give me a hotel to operate there.
So how has COVID affected what high risk is? Obviously now, we've gone through this global pandemic. The way we've done business has changed. Certain things, hotels now are booming. Before they weren't so booming. The RV industry was booming because nobody was. So how do you guys evaluate what is a high risk investment?
How does are you talking about me personally, or how does a bank executive team?
How does the higher ups, the big wigs, tell you, Eric?
Yeah.
These categories are high risk now, moving forward, because you said it varies from year to year, right, or from every quarter, or however that goes.
A lot of times, what they're doing is they're watching a lot of market trends. I'll use for an example. Again, this is a very market to market type of thing. Commercial office space. In certain markets, no one wants to get into commercial office space. There's a ton of inventory. No one wants to be in, because employees, even with employees coming back to office, I think that the peak was 37% of all employees were working remote at one point. It's dropped down to 33, close to 30% now. So it's coming back. Some people are coming back to the office, but even the companies that are everyone has to come back to the office, they're still doing only 2-3 days a week. So you don't need anywhere near as much space. And so when it comes to lending, we're looking at, we may not categorize that category of commercial office space as quote unquote high risk, but we will look at different ratios and go, okay, pre-COVID, maybe we do a 1.2 DSCR. Now we're going to look at a 1.35. And so basically it's for every dollar you're bringing in, 130. Yeah, it was for every dollar we lend you, you have to bring in $1.35 essentially.
Yeah, that's awesome.
Yeah, so it's and we talked about it before we got started.
I wanted to ask
being high risk doesn't mean no. It just means trying to mitigate that risk with other factors. So how it's structured, personal recourse. Hey, willing to put up your home as an abundance of caution, type of thing. You have equity in your home. Put that up as additional collateral or put in a more favorable position. A lot of different ways to mitigate risk, because that's really at the end, there's no risk-free loan.
Yeah.
Everything's risky.
Everything's a risk.
And it's just how are we mitigating it?
That is awesome.
And so you were asked for
Before you do that, Brian, we're going to take a quick break, pay some bills, and we'll be right back.
Back. So Eric, I had a couple questions regarding SBA loans.
Okay. All right.
Let's say someone wants to buy an office space, like you mentioned earlier, and the office space, they want to rent out part of the portion. What does the SBA offer exactly? Because I heard there were certain loans out there. If you occupy at least 51% of the space, then that can count toward the rental income, and you count that toward the DSCR, the debt service coverage ratio. Can you tell me a little bit more about that?
Yeah. So the main thing that needs to be understood about SBA lending is, and I'm not an SBA lender myself. The bank can do it. There's different underwriting guidelines and stuff. In general, you're only giving an SBA loan to someone who doesn't qualify for a conventional loan, because the SBA is going to be guaranteeing part of that loan. So the federal government is going to be involved. They want to make sure that we're just not passing the risk onto the American people. So it depends on, that question depends on the nature of the business. So say if it's an existing business, and they're expanding, either they're buying their first location or second location, that would be a 504 SBA loan, which is strictly real estate related. And the main benefit with that is it can actually be up to 90% loan to value or loan to cost.
Oh, wow.
And so it comes with less down payment. And there's a lot less restrictions on how to qualify for that. There's several nonprofits in Virginia that actually help people qualify for that, and banks work exclusively with those companies. Redco down in Fredericksburg, use them. 504 Capital based out of Norfolk, great company. Business Finance Group locally here in Northern Virginia. All of them are non-profits or not-for-profits that work with the SBA and banks to secure real estate acquisitions for new businesses that are expanding, existing businesses that are expanding. Now, if you're talking about a brand new business that's like, hey, I'm going to start a business, or maybe even have a little bit, some traction, but they need a space, and then, hey, I don't need all that space, I'm going to rent it out. It's like this 51%. It's an owner-occupied property. 51% of all the revenues coming from our borrower. It's an owner-occupied property, and then we can start working on the more intricate details. If it works without the SBA, it wouldn't make sense to do it with the SBA because SBA loans are a lot more expensive.
When you say more expensive, what do you mean by that?
So the rates. So the rates. So the banks make. So we make a margin on the interest rate, and we make a bank fee. When we do a new deal. When we do an SBA deal, we don't charge any fee. We only make money off of the margin on the secondary market. So, and it's a complicated math thing, but it ends up being where a traditional loan would say, let's say, would be 8%. I'm just using these numbers. An SBA loan is probably going to be 10, maybe even 11%. And just using these numbers because the bank's not able to charge an upfront fee. There's a lot of other factors that go into it. The SBA, they change the rules all the time. They used to charge a fairly large fee themselves to do it, and they've narrowed that down. They've brought that down a little bit, opened it up to a lot new different types of borrowers. But anyone, if you're looking for an SBA person, I know the best people in the industry to talk to. I'm just not one of them. I know how to find them, though.
And you can get a hold of Eric on the link below, right in the description. We'll have it right there. I wanted to ask you, actually, do you deal with a lot of people that commercial? You do obviously deal with commercial. That was a dumb question. But do you deal with developers and people that want to develop communities or want to develop a big office space or just they have a big chunk of land? Is that the type? Do you deal with that type of clientele as well?
Yeah, absolutely. Previous banks I've worked with on several data center deals. Trying to think. Yeah, major communities. 100 homes to up to like 300 homes. A lot of this is the cool thing. Is like once you start, it was like the science side is very scalable. It's like, hey, this is one home versus 100 homes. It's just a matter of scale. It's like figuring out all the different ratios and stuff.
Do you approach that the same way, or is it different when it comes to like developers or people that want to, essentially build from scratch?
We're approaching them fairly similar. They're usually working through maybe like a broker or a corporation versus an individual. You have slightly different dynamics. You're dealing with the SVP of development versus Joe Schmo who's buying, trying to build a home or whatever. Mm-hmm. But a lot of the conversation ends up being the same. Are you building these homes for sale, or are you going to hold and rent them out and it's going to be part of a portfolio? Mm. Different types of underwriting terms. The structure of the deal is going to be differently, whether we have certain covenants in place or we don't have certain covenants in place. And so a lot of it has to do with, again, that conversation and having those questions of like, hey, what's your plan? What's your plan? I know you need money, but what are you going to use it for, so we can structure it appropriately so we don't charge you too much, or the bank takes a haircut on it because we overextended ourselves and now have to exit a relationship because we didn't fully understand what was going on in the marketplace.
Let's say a builder finds a piece of land, right? Mm-hmm. It's 2 acres of land. It's zoned to build a bunch of townhouses on it. If they came to you and they wanted a loan to not just build properties on it, but also buy the land, is there something you can work out?
Oh, absolutely. Absolutely. Off the top of my head, I wouldn't be able to tell you like what ratios, like loan to cost or loan to value, stuff like that. It really depends on like where it is. Like, but for example, is like I was talking with someone down in the Fredericksburg area. Is we're roughly about at inventory, roughly, and the issue down there though for the builders is finding the land to build. They really don't have the land to build communities really down there, but to build these one, home here, home there, maybe a fourplex, something like that. But yeah, if a developer came and they said, "Hey, we've already got this land; it's already zoned correctly. We just need financing." Yeah, we figure out a way to start working with them. Going, all right, start going through those questions like, all right, what's your budget look like? How long is the project going to be? Are you going to build the first, let's say 4? You're going to build the first 4, sell them off, and then start doing more pre-sales as you go on. Or are you building a massive apartment complex or a condo complex, and you're going to try to sell them all, but no one's really going to go to closing a lot of times until after till the building's completely completed. So it's really all those questions. I always say this: the most unsatisfying thing when talking with a commercial lender is the answer a lot of times is, "Well, it depends. Love to have a conversation."
Yeah.
One other thing I heard, Eric, is whenever lenders give out loans to builders, is you guys always give a variable rate, not a fixed rate. Is that true?
I won't say always, but I'll say like 99% of the time.
99% of the time.
And so we're going to be giving a variable rate because there's a gap between the present as is value of the property and the completed value, and it's going as the project goes, it's going to get closer and closer and closer, and there's that property until it's sold or until it's completed and it starts to generate rental income or what other type of income it's like you wouldn't want a fixed rate, because fixed rates are for if you have principal and interest payments. Correct. Well, why are you paying out a principal on a property that doesn't exist? It's something that's not sense. Generating the revenue.
Yeah.
And so you're actually going to be paying less most of the time. So it depends on how the numbers figure out. You're actually going to be paying less by having that variable rate, because the rate doesn't change that much except for the last 4 years when it just jumped up.
Do you guys? I have 2 questions. Do you guys make those payments, or are payments due 30 days after or upon completion of the project, or how does that work?
So most construction projects are going to be, let's say if it's a single home, it's probably going to be 4 to 6 months depending on how quick the builder is. We're going to have a monthly payment the entire construction time. Okay. And then depending on the structure of the deal, let's say if it was a builder who's building one home, it's going to take them 6 months to build it. Hopefully he's already started to market it, but we're going to give probably a total of a year-long loan. And we expect to be paid back from the sale of that property before the end of that year. Okay. And so we have monthly interest-only payments the entire way, but as soon as that property sells, we'll get completely paid back 100%, and then all the additional profit goes to the builder.
Is that a negotiable thing, or is that just pretty standard? So let's say
it's fairly standard. It's fairly standard.
So you'll make, as soon as you get under contract with you'll make monthly payments on the interest, and then upon completion and move in or sell. But what about if they have a community? They built 100 homes within that community. Do you still make those monthly payments, and then for every home that's sold, you make a lump sum payment, or how does that work?
That's usually how it will work, or it will work that way, or it can work several ways. It all depends on, again, the relationship, the conversation, what is you're trying to do. Yeah, there will maybe be, so as this property, so you have your collateral pool, right? You have all these properties that are part of your collateral, and they're being parceled up, they're all going to be being sold. And so as the first one gets built and gets sold, you no longer have that as collateral, right? That now belongs to an unaffiliated person. It's like they have that. So you can no longer have that. So a lot of times what it will be is we'll only fund X amount until they're sold. Okay. And so that way it helps protect everyone involved. Because there's actually the community I live in, funny enough, it started to be built pre-2008.
Okay.
The great financial crisis happened in 2008. A lot of builders went under. A lot of people weren't able to complete projects, weren't able to do a lot of this. The lenders who properly structured some of the loans in that community were able to allow their people to, because they weren't too far ahead. Mm-hmm. So if you were building 25 homes, but you had no one buying those homes, you now have to, now you have to write off all those homes, you have to write off all of that. But if you can just leave some of the properties vacant, you don't have to build on them because the bank's not they're not dispersing undue amount of funds to you because the market's not there. And so it ends up protecting everyone where the builder doesn't get too far extended and the bank isn't extending themselves too far.
Too far. Okay.
When you're working with builders, let's say the builders run into issues with the city, they run into issues
happens all the time. Yeah.
Utility companies. What do you do as a lender to try to work with the builder to overcome it? Especially, let's say rates are starting to go up because they have over the past 2 years.
Yeah.
How do you as a lender, work with the builder? Okay, we'll keep the rate the same even though it's variable.
A lot of times that it is a matter of that conversation. Like sometimes the bank's getting squeezed on our end too. So it's like there's only so much we can do. It's like as rates go up, they actually cost us money too.
Yeah.
So for those that know, the Fed funds rate is what banks pay essentially to have to lend out money as from the Fed. So it's like we get squeezed too, and so as the rate goes up, our profit starts to get pinched as well. It stops becoming a profitable deal for the bank to do. And so that's when the conversation starts to have with the client of going, all right, does this still make sense to complete this project? And so maybe the conversation with the builder would be, hey, yeah, we'll go ahead and keep the rate at XYZ, or we'll modify it, give an extension or something like that. It's like, because anytime the county gets involved, it gets delayed. So, hey, we'll give you a little bit of an extension. We'll be able to do these other types of things. The number one thing is, are you having that conversation? It's like, I don't know how many projects I've seen where it's like it just gets delayed because the county got involved, or the builder didn't do something right, or someone said the builder didn't do something right, but they never talk to the bank. So then it comes to, hey, we're 2 months out and you're only at 25% completion. All right, what's going on? And it's been radio silent this entire time. And it's like, we know the progress because we send out inspectors to go and judge the progress. So we know where we're at before we're dispersing funds. And so that's where it gets to the point where it's like, does it still make sense on the builder side to actually complete this project? And does it make sense on the bank side to continue to lend funds for this project that now the margins went from 20% to now 15%.
Yeah.
Does it still make sense for everyone involved to continue with this, or do we sell that? Does the borrower sell that property off to another developer who will be able to do it at a cheaper rate, or is more satisfied with the smaller margins?
So, Brian, now are you more comfortable with going and buying this commercial property in Springfield now that we got our lender here?
Yeah, I wanted to actually, honestly, Eric, there's actually a property available, and if I can get it filled with tenants, would you give a loan?
I'd look at it. Yeah.
So
I'll always look at things. So I will say is I've spent the last 16 years in the Loudoun County, Fairfax County, and Washington, D.C. markets. So I'm very, very comfortable with these markets. High majority of deals up in this market are good deals.
Good deals.
Very good deals. It's all about that structure. It's like what would it be? But yeah, it's like if you already got something,
I got something cooking.
I'll have a conversation with you, man.
Yeah.
So, I won't say no.
I have a question for you here. What about somebody that has $1 million idea but no money? What do you tell them? Go make some money and then come back to me? Or it's a short plan, it's this is going to work, this is a great idea, but they don't have the funds for it. How would you advise someone to navigate through that?
Yeah, so that's a difficult question, because that's when those conversations become the real conversations. Is you have the great idea, you have the dream, you have the vision, but you don't have the capital to get it off the ground. And a lot of times this is what actually happens. They have the capital to get it off the ground, but they don't have the capital to actually operate it. And so then they end up having to sell it off. And then they literally just sold their dream. And so it's a matter of trying to figure out, like, just because you have no money right now and you have this great vision, you have this great idea, where can you get that money? So like, maybe you can't get it from me. Like there's a lot of amazing companies out there, like small companies that just don't qualify for my lending because they're too small. They just don't have enough capital to warrant me throwing debt on top of them. Essentially, that'd be unethical. I say this all the time. I hate debt. Debt destroys your asset. It pulls you down. It does all this. Love leverage. Love it. And there's a fine line between those two.
That's a great saying.
Yeah.
I hate debt. I love leverage.
Yes. Yeah.
No, that's very true.
Yeah.
I ask you that to say because everybody has these ideas and they want to get their business off the ground, or they want to buy a piece of property for, let's say, to start a convenience store or something of that nature, but they just don't have that much funding. Is there, outside of having to get other people involved as an investor, or is there any route that they would take to be able to say, hey, this is what I'm proving, this is what I'm getting out of this, I want to grow it, but I don't have that much money to get it off the ground or pay the percentage for you to lend me this money?
Yeah.
How would you tell them to navigate, or what would you tell them to do in that instance?
There could be SBA stuff involved. Again, it's like if they literally just don't have anything on. As a guarantor, they're not really worth much. There may be some stuff to work with, like with an SBA type of loan. In general, is if we can't figure out, even with the SBA being involved, if we can't figure out how to get to those loan to cost and loan to value ratios, or to the DSCR ratios, like we can't get to, I just said ratio. It's like saying an ATM machine. It's like if you can't get to those ratios, throwing debt on top of you is going to destroy you.
Sure, exactly.
It's not going. You're not going to get that leverage amount. Yeah, you want this dream to happen, but if you're bleeding cash every single month and have to pay me back my loan,
doesn't make sense.
Get on Shark Tank.
And that's the thing, is like $1 million idea with no revenue is an idea that you will sell 50% for $5,000 because you just need some capital to get started. 5 years from now, you wouldn't dream of selling 1% for $5,000. But it's all that perspective is like banks. The thing why banks are so conservative when it comes to lending is we're lending you money. We're not taking an equity in your business. Why people can go on Shark Tank, and Shark Tank, the sharks will give them money and do all this, because the sharks at the end of the day are going to own that company, or at least own it, or a good percentage of it. Banks, we're not doing that. So we have to look and go, it's like, what's in it for us? What's in it for us is, I get to see companies grow. That's my favorite part of the job, honestly, is like having conversations with business owners, getting to know them, helping them grow. Really, that's why I moved down to the Fredericksburg area. Is you can see every loan you do, you can see a lot more direct impact versus, nothing wrong with Northern Virginia, obviously. I love it up here. But you don't see as much immediate, like, hey, I did that loan, and it's providing 5 jobs or 6 jobs in a local community.
So excuse my ignorance, but if a business is doing okay, but the owner is just not the best of owners, and he's running the business to the ground, as a bank, do you step in and say, all right, we're gonna take over because we see that this is making money, but you're just not doing it right? You gotta let the business fail. Essentially,
not in a way like that. So if we're already in a lending relationship with someone, and we see that they're just not hitting the margins that we need them to see, we are going to start to move to exit that relationship. There's no way for us to take over a business. Like we're not in that type of position because we're just a lender. We're just a lender, and we expect to be paid back at least our principal. preferably our principal and our interest, because but if the company's just going under and we love the company, there's no way for us to be like, all right, fine, we'll kick you out and we'll run the business ourselves. Like, we're not in a position to do that. We don't have the expertise to do that. I'm sure there's some lenders that would love to do that, but we just have no power to actually be able to do that.
And is that kind of like, I guess, the difference between a traditional lender and a non-traditional lender?
It depends. Like, a private equity would probably, depending on what type of private equity you're doing, would probably be something like that, where they've taken an actual ownership share in that company. The bylaws or operating agreement or whatever it is has been rewritten, and these people are owners. They own, A class stock or B class stock or what have you, and they have ability. They have voting rights. They have a lot of stuff where they have the ability to kick out the current owners through voting and stuff like that.
Okay.
But so
is that a selling point that a business can give you? And say, hey, I would give you 40% equity into the business if you lend me this money. Do banks entertain something like that?
I know my bank won it. As a lender, I want it because it's
just not going to make sense.
Yeah, it's like we're not an investment bank, like an investment bank or something like that. Maybe they do that where they're taking investor capital and investing in businesses so they can get those returns like through dividends and stuff. But we're strictly conventional lending when it comes to that.
Brian, any other?
One other great point. So let's say, to Abel's point, you have a borrower, he just can't do anything. He won't pay you back. This borrower is done. You're ending the relationship. However, they have collateral, one of the 5 C's of credit we discussed. They have collateral, and the collateral happens to be a piece of real estate. What are you guys going to do with that piece of real estate?
So hopefully, and so we never, at the end of the day, it's like there's all the myth out there of like, oh, the bank purposely foreclosed on me so they could take my piece of real estate. I was like, no. I was like, it cost us way too much money to go through like that whole process of that. But I would say that's the primary collateral. It's the primary collateral. The guy's already defaulted, and we have it all on record. Everything's just above board, assuming all of this were to that point. Is we do have the right to that collateral, and so we do have the right to liquidate it at the end of the day. Now, the problem is for the bank is, say the property, he owes us $1 million, and the property is worth 1.5. We can only get $1 million out of it. It's like, so we'll put it up for auction, and it may sell for 1.5 or 2. We're only getting 1, and the rest is going to our borrower.
Most people don't know that.
Yeah. It's like we can't. It's foreclosing on people's properties and selling it is not a money making scheme that banks are even allowed to participate in.
They just got to get what they're owed.
Exactly. We get what we're owed. Plus attorney's fees, yada yada, stuff like that. It's all like, by the time you get to that stage, I'm not involved anymore. Our attorneys are. It's like I may be on the witness stand saying, I sent the letter on this date and this date and this date. I had this conversation and this call. But at that point, it's all in the hands of the attorneys.
But to be honest with you, I've actually seen a foreclosure. Let's say the debt is $1 million in this example. I've seen a bank add the attorney's fees, other fees, late charges, and then that $1 million just balloons out of nowhere, closer to the $1.5 million collateral.
It could, if the attorneys are involved on both sides, and it gets through the court system. I assume it's all above board and legal. Yeah. I'm a loan officer, not an attorney, so.
There you go. Well, that is awesome, man. Eric, thank you so much for joining us today and kind of giving us a little bit of insight.
It was fun.
So you're a banker by the day.
Yes.
And at night you do podcasts as well too. So tell us a little bit about that podcast.
Yes, absolutely. So the podcast is called Popcorn Theology, and essentially what we do, we take films and we find the intersection of where it intersects with Christian theology. Mm-hmm. And so we'll take the Marvel films, or currently going through the Rings of Power, which if you're a Lord of the Rings Tolkien fan, it's probably a terrible show. But there's some really interesting themes that actually align. Our tagline is finding the themes that align with the greatest story and the greatest storyteller.
Nice.
And so we go through that and we find those themes to receive, reject, and redeem. And it's a lot of fun. We have over 350 episodes.
That is awesome.
Nice.
So how are we able to find those episodes? Or
Yeah,
on
so
YouTube?
you can go to popcorntheology.com. That's where our entire catalog. So back in January is when we moved to start doing a lot more on YouTube. So you can find us on YouTube at Popcorn Theology. And we'll be a little red logo with like the films, and it'll say Popcorn Theology on it.
Awesome. And then your socials, if somebody wanted to talk to you about commercial real estate?
The best way to find me on socials is through LinkedIn. Yeah, so I can provide you the LinkedIn
Awesome.
thing.
We'll
But
put that in the description for you guys.
Yeah, look up Egeorge. I'm down in the Fredericksburg region. It would say GovCon and CNI lending. So you'll find me. You'll see my mug.
If you guys need to buy commercial real estate and need a loan, make sure you go to this guy, Egeorge.
Yeah.
And let him know that we sent you, so he knows that we brought him business.
Yep, absolutely. And the main thing is I'll always have an honest conversation.
Awesome.
That's the main thing about lending is I'm not trying to make a bad loan, because bad loans create a lot of headaches. I like to sleep at night. So I love to have great conversations with people and help them figure out what is they're actually looking to do.
That is awesome. And it was great conversations today. So
thank you, Abel.
I do appreciate your time.
Yeah.
My name is Abel.
My name is Burhan.
And this is the Real Estate Talk. See you guys next week.